national retail group, an advisory of 300 professionals in investment sales and capital markets throughout the country. We look forward to responding to any of your questions today and do encourage you to ask questions on your monitor. Should you at any time you experience a freeze-up audio or on screen, just hit F5 and we will refresh the screen. I'd like to turn now to Hessam Nadji, who will review the capital markets for you and give you a sense of where we are in the economy. Hessam?
Thanks, Bill. Good morning and good afternoon, everybody. Thanks for joining us again on this video live stream update for the retail market. My job today is to talk about the economy and what's happening at the macro level as well as the retail supply and demand picture. And the most newsworthy item that we'd like to start with this morning, of course, is the Federal Reserve's QE3, quantitative easing 3, that occurred last week. Its overall impact is significant for the economy and retail, which we'll discuss later in the program. Bill Hughes will be talking in more detail about it. But to start with, it was important for us to communicate with you the implications of what the Fed has done. Number one, the Fed has extended its bond buying program to the tune of $40 billion a month in mortgage-backed securities without a deadline. That's a significant difference in what the Fed had done in the past. It also has made a commitment to keep short-term interest rates low for an extended period of time to 2015. And it also is maintaining its Operation Twist, which basically is the swapping of short-term versus long-term bonds in order to keep long-term interest rates low. This really reflects a commitment, kind of a pulling of all stops to help the economy get going with a stated number of goals. Again, a little bit different than past statements that has to do with supporting the housing recovery, supporting the employment recovery and bringing unemployment down, and supporting our exports, which have been a big contributor during this recovery so far. This, coupled with what happened on behalf of the European Union not too long ago in terms of its backstopping of the European debt crisis and attempts to limit the recession in Europe by committing to a bond buying program, especially for its hardest hit countries, together make a significant difference in removing the macro clouds globally that affected our recovery. If you have watched our shows before and read our research reports, you know that we've long taken the position that the organic economic condition has been much stronger and much better than the numbers suggest, that the U.S. economy has been ready to get into an expansion mode versus a barely positive recovery mode. And it's been these macro clouds that have been a major cause of uncertainty that have held companies back and consumers back. Some of the key indicators that I've pointed to in past presentations, for example, have been retail sales in the U.S., which today exceed the pre-recession level in 2007 by 8%. This has been the case for some time as an indication of the stronger footing that the economy has had since the recession. Even on a per capita basis, accounting for population growth in the U.S., retail sales are up about 5% from the pre-recession peak. We have long looked at that as one of the main reasons we did not believe that the U.S. economy would go back into recession, but that it would struggle through this murky recovery because of the uncertainty caused by the macroeconomic conditions. These two developments over the past 45 days or so between the European Union and the U.S. Federal Reserve are a major movement forward in removing these clouds of uncertainty, but certainly not eliminating them altogether, in that besides these two factors, we have one other big factor coming up, and that is the so-called fiscal cliff, where the Bush-era taxes expire and certain government spending programs expire at the end of this year. And given the election year and the logjam in Washington, that is of significant concern because it has implications of some 5% hit to GDP. And if all of it were to happen at once, the fragile recovery that we have been experiencing would be seriously challenged. But back to the fundamentals of the economy, if you look beyond just retail sales, of course, consumption in the U.S. is 70% of our economic activity. So the retail sales numbers that I shared with you are a very good indication of the fact that we're still on a path of recovery, a slow one, but one that is sustainable, now helped by the Fed move. If you look on the company and corporate side of the ledger, you'll see that the hiring that we have experienced, as disappointing as it's been, has been very broad-based. We've added about 1.9 million private sector jobs in the last 12 months, and just about every major sector has added jobs, led by professional and business services, with just short of 580,000 jobs, education and healthcare with about 423,000 jobs, leisure and hospitality, trade and transportation, and very, very importantly, manufacturing has added about 200,000 jobs. This goes back to my comments about exports. U.S. exports have been a major contributor, and accounting for some 12% of our economic output versus single-family housing that's only contributed about 3% to our economic output. And this is part of the agenda with the Fed. Keep the exports going and help housing come back and contribute more to the recovery. So it's a broad-based recovery. Hopefully with some of this uncertainty at least reduced, we can see the momentum of the recovery pick up going into 2013, assuming the fiscal cliff is at least extended or its impact is reduced. Part of that challenge is, of course, we're going into a lame duck session post the election date, and history doesn't bode well for our ability to deal with that. So that is still a risk kind of hanging over the outlook. I wanted to share with you what's happened in terms of jobs by metro. And it's interesting to see the patterns developed. We covered this last time we had the presentation, where energy states, trade states, gateway marketplaces to both international capital and international tourism, and technology metros have led this recovery. We've seen some interesting markets rejoin their recovery, which for some time now has been led by the two major Texas metros, Houston and Dallas. Now we have Los Angeles, New York, which in the case of Los Angeles has been a laggard. Now it's adding jobs at a healthier level. New York has been one of the leading markets, as has Seattle. But a couple of markets that don't make the top 10 most active job creators include Minneapolis and Detroit, which have added about 30,000 jobs, and Atlanta, which has added about 30,000 jobs. So it's interesting to see the composition of job creation by metro. Even a market as hard-hit as Detroit is now creating jobs. On the right side of the slide, you see the laggard metros, and interesting to note there that Florida's acute housing crisis is still an overhang, and Florida has not joined the recovery to the degree that a lot of comparable markets have. And by 2013, we expect that to turn, and for Florida to become one of the more robust job creators in the country. When it comes to retail, one of the key trends that we're watching is online sales. As you can see from the graph shown here, online sales have increased by some 46% since the bottom of the recession, whereas the average for in-store retail sales have been in the 15 to 20% range. This is a very important factor for brick-and-mortar retailing. Bill Rose and I will talk more about it later in the show, but we're tracking this on a monthly basis because it has a direct and profound effect on store format, on expansion plans, on contraction plans, and it is, despite all the noise out there regarding taxation of online sales, that element in and of itself, we do not believe is going to turn the macro trend of a lot of the consumer habits now going online. It's an important indication of where the winners and losers may be in retail, as we've seen, for example, with Best Buy over the past couple of years. If you take a look at the pattern on in-store retail sales, up through a few months ago, the strength in the overall retail sales was good enough to lift in-store retail sales at a healthy clip, 5 to 7% year over year. And you can see the retail absorption numbers followed suit. What's concerning is that the last 2 or 3 months, retail sales, as they slowed, really showed up hard in the in-store retail category, slowing down to about 3%. Still positive. But this shows the vulnerability of in-store retail sales at a time when consumers may pull back a little bit. We expect that to begin, the trend to reverse again. In fact, August retail sales year over year was back up to close to 5%, compared to about 3.5% in July. It had been as much as 6 to 7% in previous months in the spring. So this is a little bit fickle, and in-store retail seems to be the most vulnerable to consumer pullbacks, and we need to be aware of that. The great news on the supply and demand front for retail has been the lack of new construction, of course, in reaction to the Great Recession. You can see here on the blue line speculative retail construction has come to a virtual halt, averaging 30 to 40 million square feet compared to as much as 150 to 200 million square feet in a normal year in previous cycles, or more during peak times. This is allowing the recovery that we are seeing quarter after quarter in the basic fundamentals of retail occupancies to bring the high vacancies down. And by the end of this year, our forecast is for continued decline in vacancies across the board. As I've pointed out in previous presentations, it's very important to distinguish the vacancy problem by vintage. And as you can see from this graph, really it's been the 3-year or newer shopping centers that were built during the boom years following housing that have had the most acute vacancy problem. The good news is we've seen a lot of correction there, and this particular trend line does not have a forecast, but through the second quarter of this year, we're seeing vacancies come down most aggressively in those types of centers or newer centers that were hit the hardest. In fact, this pattern also is mirrored by the trends we're seeing per metro. Here you see the lowest vacancy markets on the left and the highest vacancy markets on the right. This is overall retail. What's interesting is that the coastal markets, no surprise, still dominate the low vacancies that you see on the graph because of their barriers to entry and their higher than average household income levels. Retail has always performed well in those barrier markets. However, they don't have much of a problem to correct. However, if you look at markets on the right side, such as Phoenix, for example, which still has a high vacancy rate, substantially higher vacancy rate than the national average, but it's showing a rapid decline. Texas is another example of a market that typically has higher than average vacancies because of the overbuilding that goes on. However, in this cycle, there isn't much overbuilding going on. You saw their job numbers, and those vacancies are coming up pretty rapidly. So the shift that's occurring by vintage of shopping center and by type of metro in this recovery is an important investment criteria in my mind that Bill and I will discuss later in the program. So that concludes our discussion of the macroeconomic situation, and hopefully you guys are observing the same relatively optimistic and positive patterns that seems to be being announced.
Let me ask you to clarify. You just noted there the bottom 10 markets in the past have been Houston, Dallas-Fort Worth, Phoenix, yet the job growth looks really positive. So if I'm an investor, how long should I anticipate this positive job growth to affect me fundamentally in my real estate?
Well, it's happening as we speak. I mean, the vacancies in those harder hit markets with good job growth, with high vacancies, are coming down the fastest. They basically have a problem to solve, and the problem is getting solved rather quickly. The issue has always been one of timing. A lot of our California investors, for example, or New York investors, or other coastal, supply-constrained market investors that like the higher cap rates, that like the recovery play in these recovery markets, have had to time their plans in that they tend to recover, have low vacancies within about 2 to 3 years from the bottom, and then start to build again and overbuild this constant pattern of improvement and then overbuilding and improvement and overbuilding. What's different in this cycle is that the overbuilding, at least based on permitting and planning data that we're tracking, doesn't appear to be a problem right now. It could be within a year or two because these markets have less of a supply-constrained kind of an environment. So the question is, have they structurally changed? Has Atlanta or Dallas or Houston structurally changed where they're not going to overbuild as much? And I would say to some extent the answer to that is yes. I think there are at least parts of these metros that are now built out, and the threat of oversupply is far less than it was in the past. Overall, though, you have to watch them with a rather cautious eye.
Good.
Hessam, I'm curious. Obviously, there's a lot of positives what's going on to the domestic economy, but there are also clouds out there. I know you just got back from the National Multi-Housing Council board meeting. I know you had an opportunity to sit in with a number of congressmen and senators discussing what's happening in D.C. What was your takeaway from that event?
Well, the takeaway was that there is a lot of great intentions as presented to us by 11 different lawmakers that came through a 2-day session hosted by NMHC. Everybody wants to be bipartisan. Everybody understands the severity of the fiscal cliff if not addressed. I don't think there is any doubt in anybody's mind that the kind of very intense impact all hitting the economy at one time in spending cuts and tax increases would likely either stall growth altogether by the end of the spring of 2013 or possibly put us back into a recession. However, the will to compromise is the question mark. Everyone verbally is committed to compromise. Everyone verbally is committed to bipartisanship. But given what happened last year related to the debt downgrade of the U.S. and the fact that our system allowed us to get to as close as we got and then have to experience a debt downgrade, it's a bit of a concern. I didn't walk away with a clear sense that there is a solution. But I did walk away with a clear sense that everyone seems to understand the severity of the problem. It's actually a bigger problem than the U.S. debt downgrade because nevertheless, after the downgrade, we're still the gold standard, capital still flowing into the 10-year Treasury, and on a global basis, the U.S. still perceived as a gold standard. So our interest rates actually didn't go up after the debt downgrade, if you recall, last year. But we can't be messing around with a 5% hit to GDP when it comes to tax increases and spending cuts all at once. It has to be balanced. And hopefully we'll see some kind of a reasonable extension or at least reduction of the impact before it's too late.
Well, so until then, we're going to rely on QE3. Now, explain to me this. I understand QE3 to be the government buying the residential mortgage-backed securities, RMBS. How's that going to translate to growth? How's it going to translate to real estate fundamentals? Explain that piece to me.
I would love to, but let me do that after Bill talks about QE3 because that's actually a major part of Bill's message. And I think afterwards we'll have a little debate on just how effective it may or may not be.
I think it's an individual thing, and I was watching Bloomberg yesterday, and there was 15 different opinions about what was going to happen there and what the result and what impact it would have and whether it would have the same kind of impact that previous stimuli packages had. So we'll get into that in a little bit. I wanted to present this morning capital markets overview, talk a little bit about where we are. And, I hate to sound a bit like a broken record, but looking back over the last 6 months or so, other than a little interest rate volatility, there's really been very little to really hang my hat on. This morning we'll talk a little about interest rates, the availability of debt and equity products, capital providers, challenges we see in the property sector, and we'll try to give you some thoughts about where we think the market will take us over the next 6 months. In review, historically, low interest rates certainly have driven activity and returns and value in the property sector. Generally improving property fundamentals have supported continued lender consideration for the sector. It's been very positive, quite frankly. Availability of debt continues to be a tale of two cities these days, however, and I'm going to talk a little bit about that as we move forward. Deals getting done in the larger primary, secondary markets. Capital is generally available for A and B class assets, and then it becomes quite spotty for less quality, unanchored assets in smaller markets. Underwriting perspective, lenders are focused on stable income streams and streaks of tenancy, nothing really new there. Strong retail sales translate into lender confidence. I don't think that shocks anyone. We're seeing debt yields of 10 to 11% in the sector, with debt service coverages 1.3, producing loan-to-values in the 60 to 70% range for most assets that are getting done. The capital stack is adequately served by life insurance companies, local regional banks, CMBS, and private public funds. And we're starting to see some emergence of CMBS. But if you looked at this origination of product in the retail sector, certainly CMBS has lost some ground to the sector. They have been the primary supplier of debt into the sector. We look at commercial banks really having made some significant headway in the sector, particularly large national banks have increased to 30%. Overall, banks are about 47% of the sector. Life companies remain pretty stable in the mid-20s. So that's where we are. I wanted to spend a little bit of time this morning on the timeline of stimulus. I think it's important. It really talks to the fact that we've just had QE3. I think we've all had our eyes and ears listening to Bernanke, what was going to happen out of the Federal Open Market Committee last week, and obviously we saw some results. This graph really shows that every time we've entered into a stimulus package, whether it be QE1, QE2, quantitative easing, we have seen some direct improvement to employment. Employment has certainly moved up. It's certainly benefited by it. And QE3 clearly has affected the long end of the yield curve in a very positive manner. What happens with QE3 really at this point in time is anyone's guess. But as we will talk about hopefully in a minute, I think we all have our impression of how focused that particular stimulus is and what it will do to the marketplace. But stimulus has been good. We hope it will continue to be good for the economy. It may be to a lessening degree, but the reality is stimulus has been relatively good. We show this slide, core inflation versus 10-year Treasury, because traditionally there's been a direct relationship between core inflation and 10-year, and simply we've seen core inflation be significantly below the 10-year, but all of a sudden we hit last year, the summer of last year, to be specific. A lot of things happened. We had a choppy economy. We had the euro debt crisis. We had some geopolitical issues hit the market. I think fear really drove dollars into the U.S. Treasury, which is simply the gold standard. And so for the first time, we've seen the U.S. Treasury fall below core inflation. Of course, both the U.S. Treasury and the U.S. Treasury and core inflation are both below their 10-year and 40-year averages, although certainly core is pretty close to its 10-year average now. And now we've seen the 10-year move up, getting a little bit closer to core inflation. And it really should be. If in a healthy economy, you would not see 10-year Treasury certainly below core inflation. So we need that, quite frankly, move up, although we all love low interest rates. And I think that's something that we need to understand. 10-year Treasury yields, I like to show this. I spoke a little bit earlier about the volatility in the marketplace. This is really what I mean. We've seen the Treasury move around quite a bit. It's impacted by all the things that certainly have impacted the run into flight to quality in the U.S. Treasury. Today, the 10-year Treasury yield at 180 is really 50 basis points higher than it has been at its low point just a few months ago. We've seen it, back in earlier this year in March, end of March, up in the 210, 230 levels. Clearly, it's moving around. If you look at a perspective of just a very short period, we're at about 180 today. A week ago, we were 168. 6 months ago, we were at 231. And a year ago, we were at 200. So obviously, it has moved around a bit. Same concerns: domestic economy, euro debt crisis, global economic concerns, and continued subsidies and Operation Twist, and now QE3. What impact is it effectively going to have on QE3? Where is the interest rate environment going to be? Although we think it is going to be relatively range-bound, I believe somewhere between 150 and 200 between now, certainly into 2013, and perhaps beyond. We have a commitment by the central bank to keep interest rates low, as Hessam mentioned earlier, and keep them low through 2015. I wanted to spend a few minutes. We talk a little bit about delinquency rates. I think you all hear it. While the over 30-day delinquency rate for the four major food groups looks to be a little bit ragged lately, the 60-day rate, which is not shown here, has improved over the last several months, certainly. Overall, the percentage of securitized commercial mortgage classified as 60 days late decreased by 9 basis points to 8.39% in August, following a 14 basis point dip in July and a 3 basis point dip in June. While slow, we are seeing pretty consistent improvement in delinquency numbers, and that relates to retail. As it relates to retail in particular, this graph shows that it has generally stabilized this year and is now outperforming, quite frankly, the other food groups. Who would have thought a year or 2 years ago? As a general statement, we continue to see lenders dealing with issues on a one-off basis without any wholesale panic, but with an approach that maximizes returns to the investors. So you're not going to see a lot of unloading of property in the marketplace. It is somewhat business as usual as we move forward. I think CMBS product is important to the market. Really from death in 2008 through 2010, CMBS issuance emerged last year with what turned out to be a disappointing $32 billion, as most of us thought the volume would approach $50 to $60 billion. While year-to-date issuance, according to Commercial Mortgage Alert, of just under $29 billion has surpassed last year's volume of $26 billion, recent benchmark AAA pricing has brought a resurgence to the market and new issues positive. With over $4 billion in new issues being priced just this week, another $4 billion stacked up right behind it, we look to total issuance this year of $40 billion, perhaps a little bit more than $40 billion. That would be, while small, an improvement and a step forward, certainly. And what drives that? It's really CMBS spreads. The reason for all this new activity and resurgence in the new origination is shown, depicted well in this graph. In the most recent issue brought by Citi, Goldman, and Natixis, AAAs were priced at 100. As late as June of this year, they were priced at 160. So we've seen significant improvement there. We've also seen consistent improvement in the triple Bs. The pricing rally that started in June has built confidence and profits among issuers. Nothing like a little pricing rally to get things rolling, and hopefully that continues to just accelerate into the next year. We'd really love to see that market come back to be at least $50 to $60 billion next year. So let's look at investor considerations as we move forward. What we think is going to happen as an outlook. Debt and equity markets should remain stable for the foreseeable future, particularly for retail sector. We do have a choppy domestic economy. We're counting on employment. We have inconsistent indices, and obviously we have an election coming up. That is a big issue for us. Global influences are still impacting where we are with rates, with the economy. Foreign sovereign debt is still an issue. We are not done, ladies and gentlemen, with euro and the euro debt crisis. It does seem that they've made some progress, but that's not over. And now we've got some economic, geopolitical uncertainty. Capital supply to remain healthy for every asset. Although limited for some, we have life insurance companies that'll be active. Regional and local banks, I think, are going to continue to move forward. Debt funds are going to be active, and hopefully CMBS becomes more active. Investor debt strategies. We've advanced a little bit quickly. I wanted to talk a little bit for all of you investors. $1 to $10 million product is typically served by commercial banks. There are some small life insurance companies out there that'll perform in this arena. 65% loan to value, 5 to 7 year terms are generally available, 20 to 25 year repayment schedules. 5-year debts, 4 to 4.5, 7-year debts, 4.25 to 475, 10-year debts, 465 to 550. When you get into the little bit bigger market, 10 to 20 million, we've sort of segregated this for you. Commercial banks, CMBS is clearly in play. Life insurance companies are clearly in play. A few debt funds start to get in play, which will help finance higher in the capital stack. Typically 65% financing at a straight debt level. 5-year to 10-year term with 20 to 25-year repayment schedules. A little bit better pricing here, 5-year, 3 3/4 to 4 1/4, 7-year, 4 1/4 to 4 1/2, 10-year, 4 1/2 to 5 1/4. And over 20 million, we clearly have a full assortment of capital providers from large national banks, CMBS lenders, CMBS issuers, life insurance companies to debt and equity funds. They operate all along the entire capital stack. We just engaged in an $80 million cash out refinance, Class A asset in California. We priced it at $260 over swaps, 10-year deal, 5 years IO. That's a pretty good deal, and that's the kind of market we have for the better quality retail assets, certainly in the market.
Well, Bill, let's say I'm not that $80 million guy, but I'm the guy in Denver, Colorado. I just bought a $5 million shopping center. What should I look for in financing it? And what are some of the speed bumps that I should be aware of in the process?
Well, I think, Bill, that's a good question, and we work with a lot of clients on that basis. Obviously, tenancy is an important issue. We're going to look at tenancy. The strength of borrower is a very important issue to lenders these days, primarily because one of the main sources of lending in that arena would be commercial banks, life insurance companies to a second degree, but we use a lot of commercial bank lending. Commercial bank lending tends to be recourse lending. They tend to be pretty conservative in their approach. 60% loan to value. We financed a lot of those deals. You can get a pretty decent rate if you want a 10-year deal, somewhere, let's say, around 5-ish. Speed bumps are really going to be, tenant risk. As I said, strength of borrower. Location certainly is going to play into it. Major markets going to be easier to finance than certainly a secondary or tertiary market. Although we have financed certainly some of this product in tertiary markets. We've done that using localized lenders that are familiar with the real estate. They shop there, they've seen it occupied, and that's how we get that kind of product done.
Now, what if I'm the guy who I just sold my apartment building and I bought a Walgreens? How would you finance that Walgreens today?
Well, Walgreens is interesting today, and I think you brought this up for a reason. Obviously, for most of you out there, Walgreens has recently been downgraded. They were rated as an institutional credit before. They are no longer an institutional credit. I think Walgreens in particular, I don't think the credit change is sort of like the U.S. government credit change, really is not going to impact their financing much. Maybe in the CTL arena. CTL arena would be a higher leverage.
What do you mean by CTL?
It's commercial tenant lease arena.
Oh, God.
Commercial tenant lease, we can finance. You break all the rules. We can finance down to 1.03 debt service coverage. That allows us today to probably get to 93, 94% financing. They're fully amortizing loans. They don't produce much cash flow for the investor. It's the investor that wants to stock the thing away, look at it as a bond, not pay attention to it, perhaps give it to his kids at some point in time because it's going to be sitting there for a long period of time. There are lenders. The problem more than anything with Walgreens is that they've been so active in the market lately. So many of our lenders have so much of their product on their books. And lenders like to diversify. So every time we get a Walgreens, it seems that we have to go out, even though we know the last 10 deals where we put them, we have to go to those guys and we have to go to 10 other guys to see how they feel about financing Walgreens today. And it's just simply, diversification of portfolio.
Good. Well, so you mentioned QE3 and how we saw 1, 2, and now 3 and the effect on the economy. We did see job growth. Back to my question. How in the heck is buying residential mortgage-backed securities, what's it going to mean to me?
That's a very important question because it has to do with the domino effect of the economy. Housing is an important part of expansions and recoveries. Mm-hmm. In this past contraction, some 40% of the GDP contraction was attributed to housing. The average is a negative 8%. So it was acute. The housing problem was acute. Everybody knows that. In most recoveries, if you go back to the 1950s, housing contributes something around 40% by this point of recovery to economic output. in this cycle, it's been a little bit less than 17%. So housing is nowhere to be found as a driver of this recovery. And as you know, for every home that's sold, you create demand for retail, you create demand for services, and so there's a ripple effect of housing that the economy has had no benefit of in this particular recovery. So that's the first domino. It will, if it works, and I believe from a psychological point of view, certainly it is working. You see mortgage applications increasing. People are trying to take advantage of low interest rates. And will have a ripple effect through the economy. But the question is, how do we overcome the credit issues, qualifying for home loan issues? We still have a lot of consumers who are afraid of jumping back into the housing market. So it's not a kind of a fix-all element. There has to be other things that go along with it. That's why the other benefit of keeping the dollar low and keeping exports going as a contributor is another aspect, is another stated goal by the Fed. So by fixing housing and keeping the dollar low, they're basically trying to shore up the recovery and do what they can to have housing contribute more than it has so far.
Good. So priming the pump of job growth is going to lead to more sales, retail sales. It's going to lead to more tenant demand, greater expansion and growth. What does that mean for our investor world? Well, here's the slide. $33.8 billion of trades have happened first half of the year. We're projecting $60 billion by year end. The graph you're looking at, the yellow section, those are deals larger, $20 million. The blue is sub 10 and the red in the middle. So optically it appears that the larger deal size is taking up a lot of the space in the market. But let's get at the granular level. This right side of the screen is the single tenant production. $9.9 billion year to date. It is the dominant transaction within the retail category. Some 1,000 net lease properties have traded first half of the year. If we look on the right half of the chart, the multi-tenant side, this is really where the bulk of the business is happening in terms of volume. It's 70% of the volume, $23.8 billion. And what is it all about? It's an investor's demand for necessity-based retail. You heard Hessam say, what's going to happen with QE3? Well, it's all about the housing. You buy that house, you're buying Home Depot, you're buying Lowe's, you're hitting the Kroger and the Safeway. So all of the necessity-based retail is where we're seeing most of the transaction volume occurring. Let's dig into a little bit more on cap rate trends. So Bill just talked about Walgreens and our abilities to finance that. Well, this is the classic benchmark net lease tenant. And if we think about, okay, we went from A to a triple B, oh no, it's very similar to what happened in the U.S. Treasury. It is that safe haven type investment. It's a 25-year lease, triple net lease, flat term. And if I look at what happened in the marketplace from last year to 6 months ago to last week, we're trading Walgreens from Denver to Dallas to Downey, California, all in that low 6 range. And it hasn't been affected just because of the downgrading. So from my view, the downgrading, of course, is a response to Walgreens' acquisition of Boots in Europe. I suspect it'll be very much like Walgreens' acquisition of Duane Reade. Great improvement, good intrinsic value to the bottom line. The other category here in net lease is fast food. Yum Brands, which is KFC, Taco Bell, et cetera. These are the very popular product types. There are 10-year leases, 15-year, and some. And they have growth. They have 10% rent bumps every 5 years. Average price of these properties, about $1.8 million. So it is that very common underlying product that we see in the investor pools. When you look at cap rates, we're saying a 7 generically across the country. Now, I'm not a big fan of averages, so I do encourage you to reach out to any of your local investment advisors of our firm and get their take on where properties might trade specifically within your market. This is a very interesting comment, and it really leads to what Bill is talking about in the CMBS space. If you look at these graphs, the red line is our cap rate trend. The blue line is the U.S. Treasury. Well, you could say, okay, well, a 200 spread over Treasury is where my net lease deal should trade today. Okay, that would be a 4 cap. I don't know that we have a 4 cap unless it's a McDonald's as a trend, but what I do predict is as CMBS starts to ramp up, we're going to see those lines come together again. And it should be something more of a greater capacity. Does that mean the 5.5 cap range will be the common evaluation of a core grocery-anchored center in major markets? I think the answer is yes to that. Let's look at the REITs. So if you are not a direct investor in commercial real estate, perhaps you own Simon as a stock or Kimco as a stock, the green line is indicating the REIT performance is way ahead of all other asset classes. In the red line there, that's all REITs. So the office REITs like a Kilroy, the apartments REITs like an Essex, or as I said, the retail REITs are outperforming those others. Why? These are bonded, credit-rated tenants predominantly. They have good, consistent cash flow. It's predictable cash flow given that these leases are 5, 10, 15-year terms. And in relationship to the S&P, way on top. So if we think about whether we are a stockholder in these REITs or whether we're a direct owner, maybe in a net lease property or even in a larger shopping center property, clearly it's the better way to hedge against bonds. And if you look at the predictions that we talked about last November with you, one, we said that commercial real estate would provide better risk-adjusted returns. Well, there's the facts. Secondarily, if you're a direct owner, you are getting the benefits of depreciation. This core asset to push high watermarks. 2 points there. The pension funds have been very effective in chasing these deals. Why? They're needing to buy fixed income assets. And if we look at those core properties, those fortress-type assets, shopping malls, they've been a big investor in that arena, and it's causing cap rate compression significantly. If we look at multi-tenant shopping centers in the midsection of the country, of those properties of trade in the first half, roughly 200 of them occurred in the Great Lakes region. Why? Many investors are looking to get a better yield on their investment, and in those markets you can get into the high nines. The pension funds, as I noted earlier, they're winning a lot of the business. They're willing to pay that 5.5 cap rate on a core anchored center in a major MSA. So see that continue to happen. Lastly, private investment growth is contingent upon CMBS. At our retail trends events that we hold in Las Vegas, we've had Goldman Sachs and Wells Fargo come to these events and tell us that we really think the business is going to ramp up. Clearly, there is no absence of demand to buy the securitizations. It's our ability to underwrite them, finance them, get the system rolling. So from my perspective, as soon as we see CMBS hit that 60, 70, 80 million or $billion mark annual production, that's when our market really is going to find a stabilized space. Hessam, back to you and our clients.
Right. We have received a lot of great questions. I'm going to start with a couple of more macro questions, and then we'll zoom in some of your comments, Bill, that triggered a number of questions from our audience members. First of all, a number of investors want to know from all of us collectively whether this aggressive bond buying program, what the Fed is doing, is eventually going to lead to hyperinflation, and what the outlook for inflation may be. Bill, you want to start with that?
Yeah, I think the Fed is very sensitive to the inflation issue. I think they're watching it carefully, and as soon as they see inflation starting to take a hold, as soon as I think they see the economy start to move forward again, really led by job creation and significant job creation, I think we have a long way to go there. I think the Fed will start paring it back. But I don't think, as the central bank committee members have all basically agreed to, is there's really no pressure for inflation out there. And will it come? Yes, a little bit of inflation is a pretty good thing for us in the real estate business, but I don't think it's going to be a major concern for the foreseeable future. Certainly not into 2013. I'd love to see a little inflation hit us in 2014, meaning the economy is stabilized, moving forward, we have good job growth, rents go up, values go up. I think things are good in the retail industry then.
I think it's a little bit of a balancing act. If left alone, the amount of liquidity that's in the system could lead to an inflation problem. And remember, even before the Fed acts, there is the investors' inflation expectations, which could affect the yield on the 10-year Treasury. So I agree with you 100% that it's all about unemployment. When you're running unemployment at 8% and underemployment, which is all the other people that are jobless but have given up, at 15%, which is a very high number, you really don't have a lot of driver for inflation. But if the mopping up and the removal of excess liquidity from the system doesn't happen just about at the right time, we could have a little bit of an inflation expectation issue. And to that end, Bill, you mentioned range-bound forecast for the 10-year Treasury in the 1.5 to 2. Going into 2013, let's assume for a moment there is a resolution or an extension of some sort for the fiscal cliff, and the mechanisms that the Fed has put into play have a moderately positive effect, and job growth improves. By middle of 2013, don't you think we could potentially see the 10-year in the 2 to 2.5 range?
Well, clearly at that point in time, but I was talking about really through this year and into next year.
Okay.
I think next year we're certainly going to see some pressure on rates. I'd like to think, quite frankly, it's beyond 2%, and it pushes forward. I think beyond the local economy, though, there's still some other factors that play into the game, and that's the global economy.
Sure.
You know, what's happening with China at that point in time? What's happening with Japan at that point in time? What's happening to some of the stronger countries in their economies? And then are we through this euro debt issue that we have? I'm not sure we are. I think they're just at sort of the beginning. If you've got a 9-inning baseball game, they're in the second inning. I think there's a long way to go there. So every time we've seen positive things in this economy, and we think, okay, interest rates are starting to move up a little bit. Boy, that's sort of been the hammer that's kept us back down a little bit.
Very good point. Bill, switching gears to more of a retail question. You mentioned the importance of CMBS, even for the private investor. And obviously when CMBS is fully functional, which it still isn't compared to what it was, not at the froth of the marketplace, but even before the froth in 2004, let's say 2003, 2004, which is kind of viewed as the more of a normal environment before the craziness really hit in 06 and 07. And besides the mechanism of being able to take loans off the hands of the facilitators by securitizing and having investors basically offload and free up the originators to go originate more loans and then package them and sell them to investors. Why is CMBS so important to private investors? I certainly understand the importance of it to the larger, more institutional and very large private investors, but a number of our audience members want to know why you mentioned it as such an important factor for the average private investor.
It truly is that synergistic relationship between debt and equity. If I want to go buy that $10 million shopping center down the street, I'm not going to buy it all cash. It's trading today at 7.5 cap. Bill's quoting ranges somewhere in the low 7 constant. That's a 50 basis point leverage for me. So, leveraging up and improving my cash on cash return, very favorable. The commercial banks alone cannot create that much volume. Today, we're at about 20% of the peak in 2007 in CMBS productions. Life cos have always been so disciplined. Once they hit their allocations, they're done. And to be a life co borrower, you really need to be a purist real estate investor, no black marks in your history, great credit background. The banks, mostly relationship lending. So CMBS provided this great environment of non-recourse debt, provided that the real estate was of good quality, good location, had fundamentals that allowed for much more liquidity in the market. More liquidity, more investment, higher yields. So that, to me, is what is critically important about really lifting our business back to the volumes of 2007. Liquidity. Very much like QE 1, 2, and 3, liquidity.
Right. Although I don't know if 2007 is a realistic benchmark given how far off normal it was.
So that's crazy underwriting, but what's
even
great,
2004, like I said, 2003, 2004, which actually we're close. Right. We're coming up on where we were in 2004 based on your chart.
Very much so. We're at 65% in terms of volume. We did $100 billion in business in 2007, and we're at near $60 billion today. Right. Bill's commentary about underwriting and the delinquency, I recall the graph planing out. Underwriting is solid today. It's not crazy underwriting. It's not this 95 spread over the Treasury type mentality. So I think moving forward, we've got real clear sobriety in how these deals are being underwritten, creating greater confidence in that secondary market.
It seems that if you were to roll up everything we're talking about here, between the economy, capital markets, interest rates, underwriting, supply and demand fundamentals, that the bottom line news is that if you had an asset that was in trouble, You couldn't do much with it. You couldn't refinance it. The market wasn't there to sell it. Even a year or 18 months ago. Today, there's a lot more options on the table from the standpoint of both the values coming back, buyer demand coming back, lenders coming back. Is that the main message? I mean, there's much more option even for the worst case scenario.
I think really what we've seen in the financing arena is the fact that, we've had these funds now that are willing to operate along the capital stack to help clients recapitalize deals if that's where they have to go. Certainly there are more local banks involved in the arena. Big national banks are in the arena of financing deals. Life companies, as Bill was saying, I was sort of chuckling, the amount of business that life companies have done over the last year, which we have to realize that a lot of that business was in refinancing their own portfolios. Interest rates are so low for them that on a risk-related return, it's better for them to finance a deal that's maturing in their own portfolio at a low rate than going out and starting a new deal. So I think that things are, much better. Are they where we'd like them to be in a perfect arena? And we could finance all asset classes and all markets all the time. We're not there yet, and certainly there's some room for improvement.
Especially tertiary markets, hard-hit areas, and so on. Mm-hmm. Bill, another investor question for you regarding retailers and their strategies. It seems like there's more store openings being announced. Some retailers are on the move. They are expanding, maybe for the first time since the recession and so on. What are some of the reformatting, re-strategizing, reshaping trends that are out there that investors should be aware of?
Well, there's always been that concern of retail reinventing. It's been an ongoing evolution of retail. It started back in the mercantile, went to the Costco, and today, lifestyle centers are certainly in vogue in some markets. One concern is that, here's this large 40,000 square foot Best Buy, and now Best Buy is consolidating and doing more internet sales. How does that affect me? In many cases, we've seen a Walmart, by way of example, closing a store, going across the street to do a super. Well, that remaining Walmart has been backfilled by a Hobby Lobby, by a number of these other different tenants who do backfill the space. So as an investor, I'd be concerned about where's it all going? If I buy this property today, do I have residual value? Can I re-tenant the building? That would be my number one concern in buying a property. Secondarily, retail is always evolving. Before the internet, we didn't have it, so it was a direct order catalog business that was chewing into bricks and mortars. Now with the internet here today, it's great. We can buy something right off the iPad and it shows up at home. It won't be the death knell of retail. Retail is a see and be seen experience. We love to go and see you at the mall. Hey, what are you and your wife doing? That's not ever going to change. So I think for us as investors, we need to be focused on necessity-based retail and not be concerned about perhaps the internet eating into that.
If you have Best Buy as a tenant, certainly there is a direct effect, and they're looking to react and survive, and they've come up with all kinds of different plans. As an investor, how do you play that, or how do you avoid the hit? Necessity retail, obviously, one way to go. And then on the offensive side, how do you take advantage of it as a value investor?
So if I'm a value investor, maybe I bought a Best Buy, and now they've said, okay, we're going to close because we're down the street. Fine. From an opportunistic point of view, Walmart is out there expanding because there's many markets. They're urban infill. They can't fit a 200,000 square foot box. They're looking for now a 14,000 square foot box. We look at retailers like Target that wants to have their city Target concept. Dollar General noted 600 new units in the West Coast. They've predominantly been more of a Southeast type retailer. So from that opportunistic point of view, I've always felt if the real estate is good, there's going to be a tenant for that space. Blockbuster, this is my favorite example. A lot of our investors out there bought that 6,000 square foot Blockbuster. Well, guess what? Their real estate criteria was typically on the end cap of a shopping center, and you can easily recarve that space into 4 smaller type suites, which will accommodate the nail salon, the Subway, Jimmy John's, which is crazy, or Jersey Mike's, which my kids are just freaks over today. So there's that constant evolution. And if the real estate's solid, you'll always have a tenant to fill the space.
That ties into another question that we've gotten from another investor, and that is for the true value add, high risk, re-tenanting, repositioning. Question to both of you: is it time to get into that higher risk kind of a complete value add scenario, and can you finance it? Bill, is it time?
So first, absolutely the time. 2009 benchmarked the bottom of the market. Blackstone made a $9 billion investment in Centro. I think that was a key indicator that one of the industry's most progressive, aggressive investors bought Centro in 2009. Of late, they reinvested with DDR in a joint venture on $1.4 billion acquisition of EPN shopping centers. So the industry is saying, yes, it is time from a capital market perspective, but you need to have stamina. Because if you've shown in our growth numbers, job growth is good. It's coming. It isn't going to be this quick return. But if I'm a 10-year guy and I say I'm buying a shopping center today at a mid-15, cap perhaps, middle market, maybe it's a strong market like a Cleveland, North Detroit, Houston, love it. There's growth, income, crossroads. Yes, that's a great opportunistic play, but I got to have stamina. It's going to take some time.
Bill, can you finance it?
Well, I was going to say my answer to that question is when I look at the number of lenders available to finance that value-add transaction, a bridge deal where it needs to be repositioned, you're going to maybe have to put some more capital in and you're going to need some higher leverage financing. There are clearly more bridge lenders and more lenders available to you as an owner-operator to be able to go through that development than there were before with many structures. So we can finance those deals. Clearly, lenders are going to be concerned about the market, what's going to drive it, who are you as the borrower in terms of attracting tenants, who do you have in your back pocket, how do you put that deal together, and can you really hit the returns you think you're going to hit, because they are going to want to be paid off in, whether it be 3 years, maybe 5 years, they're going to want to get out, and you've got to show them a definite exit, and it's got to be based on real-world information.
From the equity markets as well, for a while there it was off. If you said, hey, I need equity for a new project, great, go away. Today, not only is it there for the co-invest, but there is now general partner equity available, which I haven't heard that since 2007. So from my perspective, not only if you find a great value-add project, sure, you're going to get an equity partner to co-invest with you, but if you need general partner level equity, that's available too. So I think every indicator is there, but we all need to be very smart. This is a 10-year horizon, not the 3-year quickie horizon.
Great comment. With that, we're at our 1 hour mark. We have a lot more questions that we didn't get to, which we will respond to by email. Good. But I will turn over to you for closing comments, Bill.
Hey, thank you again very much. We always love to come back to the market and speak to you about what we're seeing from a macro level at 30,000 square feet, or pardon me, 30,000 feet. I do encourage you to reach out to your local investment advisor, capital markets originator, get their take on your property specifically so that you do have good guidance moving forward. Always good to see you. We look forward to seeing you again in February of 2013 when we recap the close of 2012 and looking forward to the markets of 2013. Hessam, Bill, great to have you. Good to see you.
It's a pleasure.
Thank you.
Thanks.
Thank you.